Welcome to The Explainer. Today, we're diving into a genuinely paradigm-shifting analysis based on Mark Douglas's groundbreaking book, Trading in the Zone. If you've ever stared down a stock chart, nailed the prediction, but then just completely frozen up when it was time to actually push the button, well, you are exactly in the right place. We're going to unpack exactly why psychological mastery, and not your shiny analytical tools or your chart reading skills, is literally the ultimate trading edge.
So let's dive right in with a pretty staggering number, 95%. According to the source material, a full 95% of futures traders blow through all their money within their very first year of trading. Stop and just let that sink in for a second. It's a harsh reality. And frankly, stock traders generally see the exact same abysmal results. Which naturally brings us to a really fascinating question. Why do society's absolute brightest professionals fail so miserably as traders? Because we're not talking about reckless gamblers here. We're talking about doctors, lawyers, engineers, CEOs, people who are highly educated and literally excel everywhere else in their lives. But they step into the markets and bam, they hit a brick wall. Why does everything that made them successful out there in society suddenly work against them? Well, to figure that out, let's move into Section 1, the illusion of analysis. To understand why these smart people fail, we kind of have to track the natural life cycle of a novice trader and this inevitable trap they fall right into. It's basically the trader's journey. Step 1 is usually a carefree win. A newbie starts trading, they have absolutely no real concept of the danger, and they get hit with beginner's luck. They win. It feels incredibly easy, right? But since they don't actually possess a successful trader's mindset, Step 2 comes knocking, a devastating, emotionally painful loss. Now, to prevent that pain from ever happening again, they shift into Step 3, which is revenge analysis. They obsessively hunt for more market knowledge, totally convinced that if they just learn enough indicators, they can avoid losing altogether. But here's the thing. The market can do anything, at any time. And realizing that literally no amount of knowledge can prevent a loss, that leads straight to Step 4, total paralysis and fear. Let's look at how the trading industry itself actually tried to solve this problem over the years. Originally, the focus was entirely on fundamental analysis, looking at interest rates, balance sheets, and mathematical models to predict what the market should do. But this created a massive reality gap because it completely ignored the actual emotional humans doing the buying and selling. So the industry shifted gears to technical analysis. This closed the gap by focusing on collective behavior patterns and what the market is actually doing right now. But fixing the analysis just ended up uncovering a brand new problem. And that perfectly illustrates the real issue at play here, the psychological gap. This is that massive, frustrating difference between looking at a chart, correctly predicting a market move, and actually executing the trade without any fear, hesitation, or regret. The deep irony here, and it's a big one, is that acquiring more technical knowledge often makes a trader less successful. Crazy, right? But why? Well, because more knowledge just inflates your expectations. When the market doesn't do what your brilliant, foolproof analysis said it would, it hurts even more, keeping you totally trapped in that psychological gap. Which brings us to Section 2, the limitless freedom trap. We really need to shift our focus to the root cause of this mental block. Why is this gap so incredibly hard to bridge? The crucial point is this fundamental clash. Just think about how we were raised. Society's rules are structured, they're finite, they're safe. Your parents, your teachers, your bosses, they provide external rules to protect you and guide your behavior. If you mess up, an outside force corrects you. But look at the market's rules. They are totally unstructured, infinite, and inherently dangerous. A trade has no defined beginning or end. It starts when you decide and ends when you decide. You have limitless freedom. For literally the first time in your life, there is zero external structure to save you from yourself. And to make matters worse, this limitless environment is highly addictive. The text actually references this fascinating psychological experiment with monkeys. If you reward a monkey every single time it does a task, and then you just stop the reward, the monkey quickly quits doing the task. Makes sense. But if you reward the monkey randomly and then stop, the monkey will just keep doing the task indefinitely. Because the payout was always unpredictable, they just keep trying, hoping for that surprise hit of euphoria. Traders fall right into this exact same random reward addiction. They ignore risk because, well, any random trade could be the big winner. All right, moving on to Section 3, the boom and bust cycle. Let's introduce the different ways traders actually react to these intense psychological pressures and how it directly dictates their bottom line. Based on the analysis of active market participants, about 10% are consistent winners, 40% are consistent losers. But that massive chunk right in the middle, a whopping 50%, are what the author calls boom and busters. Now, these people are actually good enough to make money. They can put together a beautiful string of winning trades. But because they haven't rewired their minds to deal with that limitless freedom we just talked about, they completely lack the mindset to actually keep the money. These boom and busters are inevitably wiped out by two really powerful psychological forces. The first is euphoria. After a string of wins, they get super overconfident. They start to feel like they literally are the market. Believing nothing can go wrong, they put on oversized positions and completely ignore all risk management. Until, boom, a single trade wipes them out entirely. The second force is self-sabotage. These are those subtle, reckless errors driven by deep subconscious conflicts. Like maybe feeling deep down that they don't truly deserve the money or the success. So, how do we fix this? Let's dive into Section 4, Mastering the Trader Mindset. How exactly does that elite 10% rewire their mental software to achieve consistent success? Well, the absolute first step is adopting a crucial, non-negotiable belief. The market is a neutral mirror. It doesn't know you, and it owes you absolutely nothing. The market just generates objective information. Every tick up or down is just data. If you feel angry, frustrated, or betrayed by a trade, that is purely the result of you projecting your own expectations onto a completely neutral environment. The market isn't out to get you. You're doing it to yourself. The ultimate goal here is reaching the zone. This is a fearless, totally carefree state of mind where a trader just acts instinctively. It's actually incredibly similar to an elite athlete entering the zone during a massive game. In this state, you completely accept the risk, and you are totally unburdened by past emotional pain. You don't rationalize, you don't second guess, and you definitely don't hesitate. You just flow with the opportunities as they come. And this brings us to the core difference between an amateur and a pro. Amateurs are constantly focused on avoiding pain. They rationalize bad trades, hesitate on good ones, and blame the market to protect their own ego. Professionals, on the other hand, operate purely on taking responsibility. They accept that 100% of all outcomes are self-generated. They fully, truly embrace the risk before they ever even click buy. If you shift the blame, you never learn, and you stay trapped. It's that simple. Let's look at the core, non-negotiable beliefs you actually need to build this winner's mindset. First, you must trade completely without fear or recklessness. You must define and truly, at your core, accept the risk before entering a trade. You've got to train your brain to think entirely in probabilities, not certainties. There is absolutely no for sure in the market. You must stop trying to force the market to give you what you want. And finally, you must eliminate the threat of pain from market information. Think about it. If market data can't hurt your feelings, there's literally nothing to be afraid of. So the whole crucial point is summed up in this incredibly powerful quote: consistency is a state of mind that has at its core certain fundamental thinking strategies that are unique to trading. Consistency is not some perfect algorithmic strategy. It's not a magical technical indicator. It is an internal psychological framework. You really cannot expect the market to make you consistently successful any more than you can expect the outside world to make you consistently happy. It all has to come from within. As we wrap up, I want to leave you with a profound and maybe a little provocative question to really chew on before you ever look at another chart. Are you fighting the market, or are you really just fighting yourself? Your edge isn't out there on the screen. It's entirely inside your mind. Thank you so much for joining me for this explainer, and I highly, highly encourage you to take a hard look inward before your next trade.